The views and opinions expressed in this podcast do not necessarily reflect the views or positions of ACUMA, its board of directors, its management staff, or its members. The podcast discussion presented is conversational in nature and for general information only.
Hello and welcome to ACUMA's On Point Podcast, the policy series, where we focus on policy issues impacting the credit union mortgage industry. I'm your host, Peter Benjamin. Joining us today is our resident expert, Zach Pfister, Policy Director with Brownstein. Zach, my friend, how are you doing today?
I'm doing well, Peter. It's good to be here.
I'm good. Now, I have to call this out. Your voice sounds a little raspy, like almost as though you've been yelling at a TV screen or something. I don't know what it is, but I don't know. It seems like a lot's going on in DC at the moment. And I think we could probably take this episode in thousands of different directions. I went into today thinking, okay, well, how do I not make this about the CFPB, etc.? But there's just too much not to discuss. So I'm going to let you just jump right in and discuss whatever you so choose. But I imagine CFPB is going to be on the docket. So fire away whenever you so. All right. All right. After you, sir.
So with respect to the CFPB developments, I think if we look back, let's look back a few weeks. We had, for a moment there, an acting director dissent, followed by an acting director vote. Russ Vogt, who is the current recently confirmed director of the OMB. He's in that position for the time being. It's possible we're hearing rumors that there may be another acting director in the coming weeks. Some moves being made in the interim while Jonathan McKernan, the nominee for the permanent position, makes his way through the confirmation process. McKernan comes from the FDIC. He has a reputation of being a serious regulator. He was previously on the Hill for the Senate Banking Committee with then Chairman Pat Toomey. Like I said, he's known as a serious regulator. He was a senior advisor at FHFA. It was an interesting pick, given the dynamics around what the Department of Government Efficiency, the DOGE team, has been doing over at the CFPB with respect to proposed cuts and layoffs, terminations, freezes of all actions, enforcement, supervisory, or otherwise. That said, it does give an indication that the CFPB will continue in some fashion. It's just not clear at this moment what that is. If you look at some of the developments over the last 7 days, there have been over 1,000 terminations at the CFPB. Across various positions, in all kind of departments of the bureau. The freeze at the bureau remains in effect, kind of indefinitely for the time being, pending either further announcements from the acting director or results from various pieces of litigation underway. The litigation that's been filed against the CFPB at the moment is more geared towards the employment component of what's going on there. But it's all to say that everything is pointing to a much smaller bureau, a much less active bureau, one that is certainly going to take a different approach than the previous 4 years. One would argue that there may even be attempts underway to simply let the bureau kind of attrition out of existence. Absent an act of Congress, that's not entirely possible, unless Congress passes a bill that would repeal Dodd-Frank or abolish the CFPB. It would stop short of that. But I would note one of the most telling examples of the direction in which they are going, at least in the interim, is that the acting director did not request the monetary advance from the Fed that funds the Bureau. So the CFPB is not funded by appropriations. It is funded via an advance from the Federal Reserve. Those advances happen on a quarterly basis. I think the CFPB's budget last year was somewhere around $740 million. The first action that the new acting director took upon taking up the role was sending a letter to the Federal Reserve saying that they will not be requesting their quarterly advance. So this is kind of the information we have at the moment, and it's very fluid, but it does seem like more terminations are forthcoming. This is looking a lot more reminiscent to what happened over at USAID, where they had a staff of 10,000, and now they have a staff of 250. Or at the end of the day, that's the end goal there. The CFPB is heading in that trajectory, barring any further court decisions, but we shall see. Ask me again in 2 weeks, and I think we'll have a very clear picture.
So, I mean, obviously a lot of questions, based off all of everything you just said. So I'm going to start with, the first question that I have to ask, and it's going back to one of the first things you said. And this, I'm going to preface this by saying maybe this is just, I'm sorry for the pause, and I'm trying to frame it up in the most intelligent way I possibly can, but maybe there's not. Why so many acting directors, one after another? Is there a reason for it, or is it just, why not just pick one acting director and just have them ride it out? It seems like the administration, or maybe it's someone else, is assigning acting directors, and then they're just passing it off to the next person, then passing it off to the next person until McKernan is in place. Why that?
So it's a couple of things. One, the timing of the timing of the inauguration with where they were in the process on vetting candidates. They obviously were more squarely focused on getting their cabinet nominees named and into the process. The regulator level nominees came second, right? But with respect to the CFPB in particular, it has historically been this is only the second time around that we would have had this scenario, but it was not easy to fill the first time around in a Republican administration. The Bureau was born out of an all Democratic government at the time of Dodd-Frank's passage. It had no support in Congress among Republicans. It was not, supported by the last administration to much degree. And accordingly, from a qualification standpoint, frankly, I think it's hard to find interested candidates willing to do the job, right?
Right.
On top of that, I think that there were some previous folks who had worked at the Bureau during the first Trump administration who politely declined to take a second tour of duty. There were some others in the mix who are longstanding names who have been some of the other regulators, and for one reason or another, they didn't end up landing in that spot. And McKernan's name was always kind of out there as a potential as well. I mean, that the pool of potential names was always small to begin with, and some of those individuals landed in different positions across the administration. The reason that they name an acting, immediately and then transition it over is that as new individuals were confirmed, that simply means that someone closer to the ground can take the reins while they wait for a permanent director. It would be, quite difficult for the Treasury Secretary in the midst of being one of the primary negotiators on tax reform with Congress and the international markets and everything that Treasury secretary's role entails, to also be kind of an effective dual hat director of the CFPB. In the last administration, at the time, Mick Mulvaney, who was the director of the OMB, was also for a period the acting director of the CFPB. So there's some precedent there. But Russ Vogt, the current OMB director, who is currently also the acting director of CFPB, he is the how would I describe it? He's the guy with the red pen. And for an administration that is looking to cut costs, cut headcount, cut regulation, a lot of that power and influence lies with Russ Vogt. So him being an interim pick for the time being, given what has unfolded over the last 2 weeks, in hindsight, makes perfect sense, right? If that's the goal, then there's no better person for the job than Russ Vogt. He knows the federal budget process and appropriations process like the back of his hand. There are a few in D.C. who know it at a more technical level than he does. And if there's a way to unwind an agency, Russ Vogt's going to know how to do it and do it effectively. Now, I think that there are fissures in the unity, on Capitol Hill. Not to speak for my, my Republican counterparts, but it seems clear that the in conversations with both, Democrats and Republicans on the Hill, and they've said this publicly, that they have very little insight into those decisions that are being made over at the Bureau right now, because it's not being done in consultation with Congress, nor is any of the other, moves being made by the kind of roving DOJ team. This is not unique to CFPB. You're seeing this kind of across the board at all the agencies at the moment. And so every few days you get a breaking news alert that says the DOJ team has arrived at the Department of XYZ, and that's what that means, right? They're there to examine and potentially make similar budget reductions and headcount layoffs.
Okay. And thank you for walking us through that. So, next question is, obviously by reducing, the staff by whatever percent, let's say 75%, right? The argument is that as though they're going to push the type of regulation or enforcement, back onto the states, right? You could easily see them doing that, right? Some states like California already have their own version of the CFPB, right?
Right.
But then you could easily argue that, there are some states that truly bleed red, like Alabama, that have a long history of RESPA enforcement. So is that really the right play to push it back on the states necessarily?
I would almost frame it a different way. The key for, I think, for ACUMA members, the key thing to remember during this period of time, whether it is 3 months or 3 years, the law is still the law, and the regs that are on the books are still the regs that are on the books. Whether or not the current agency is examining or enforcing, that's another issue. Regulated entities still need to comply with existing statute, and so we're getting a lot of questions around what does this mean for for existing rules or for rules that were just made final. It's a good question, but there's an APA process for that, and should the executive branch wish to undo the regs themselves, they've got to go through that process, right? Mm-hmm. So just you could fire every single person at the CFPB. It doesn't make the regs go over. Now, does it allow for entry points for less scrupulous bad actors to roll the dice? You bet it does, right? But does it mean that a credit union or a bank who have been complying with these laws for years are simply going to walk away? I highly doubt it, because the liability on the back end of these decisions whether whether this is a temporary void in enforcement and supervision, or whether it is prolonged. I think the liabilities outweigh any near-term benefits of not complying with what we've been complying with all along. I would also note the other day in his semi-annual testimony to Congress, Federal Reserve Chair Powell was asked, I think it was by Elizabeth Warren, are there any other, does the Fed have the authority to, enforce these consumer protection laws in the book? Is there any other prudential regulator that has these authorities to enforce the Bureau's responsibilities currently? And the answer was no, right? The answer was that there are statutes that are unique to the CFPB from an enforcement perspective, and the Bureau is solely responsible for enforcing those regulations. So there may be, fewer examiners coming up, coming through in the months ahead. There may be fewer rulemakings, no doubt, or supervisory opinions coming out in the coming months. But that doesn't mean that credit unions should take their eyes off of regular compliance with existing consumer protection laws by any stretch of the imagination.
Okay, great. All right, just for the sake of time, let's move away from the CFPB. As much as I know we could fill this whole episode with just the CFPB, what else is happening with or in DC?
Gosh, where do we start?
How about this? Let's do a quick hit.
Yeah,
HUD.
Yeah. So you've probably seen recent announcements of significant staff reductions at HUD. Again, I would go back to my earlier comment. This is not unique to HUD. This is not unique to the CFPB. There are roughly 200,000, last checked, 200,000 federal employees who fall under the designation of probationary. That means someone, depending on the agency, that means someone who was hired within the last year or 2 years. Those employees, unfortunately, are the ones with the fewest protections, right? And so when you're looking at wholesale reduction of workforce, this is similar to kind of a corporate playbook where it's the lowest hanging fruit in terms of headcount reduction is terminating these probationary employees. We've seen over the last 48 hours, 72 hours, thousands across dozens of agencies that have been announced. All, the relative point in connection to all of them is that they're all probationary employees. Now, the HUD piece in particular, obviously, 50% of HUD is not a probationary designation. With HUD, there are other factors at play there. There's the historical degree of importance that Republican administrations probably pay compared to Democratic administrations on the value of HUD in and of itself. There's the regulatory component where the result in further reductions and proposed consolidation among certain regulators may play a potential role there. And then there's anything that touches what the administration deems in its executive orders as related to issues around DEI. So any initiatives, programs, officials, anyone with a title that is even closely related to the issue, they run the risk of having their position eliminated based off of what was kind of outlined in the president's executive orders early on in shortly after his inauguration. So it's impactful, right? We could see significant reductions, and what that means is, I've said this on previous podcasts. When a regulated entity is seeking to comply, if they can't get someone on the phone from their regulator or from their program manager, that's going to create problems, right? And it's going to create uncertainty in the business community. And we can have differing opinions about which regulations are good regulations and which regulations are burdensome. But if in many cases, no response is not a good response either. And I think that there will be a tail on this where it takes time to see some of the implications here. But when you reduce a workforce by this size on this big of a ship this quickly, you're bound to have some collateral damage, and the verdict will be out there for a bit, but it's notable, and they will be sizable.
So, and again, this might be a stupid question, but going back 2-3 weeks when the administration came out and said, here's a package, right? And I forgot what the package was. It was like 6 months, 8 months, something like that.
Oh, the resignation.
Resignation package, right? I mean, I'm assuming not a lot of people took the administration up on that offer, or maybe they did.
It was below their estimate, but above, I guess, my estimate.
Okay.
I think their goal was 100,000, and I think by the day of the deadline, which I think was extended for 2 days, I think they landed. They claim to have landed somewhere around 75,000.
Okay.
75,000 who took this buyout, which is, I think most observers look at it as legally dubious as to whether the government can actually offer a buyout along those lines. There's that, and then there are the roughly 200,000 probationary employees who hypothetically are in the crosshairs, and then there are the folks that will get fired for. I say fired for cause, but fired at will, I guess, is really the term based off of the nature of their positions. Kind of going back to my earlier comments around DEI as an example.
So, but kind of completing that thought is this cut 50% workforce cut at HUD the result of that deficit of 25,000?
The deficit of 25,000. You mean the deficit of 75,000?
Well, you said they fell short of. They got the 75,000, right?
Oh, I see what you're saying. So because they fell short on their goal for buyouts. No, I think it's parallel. One is not mutually exclusive from the other, right? These other terminations were going to happen regardless. The buyout offer is arguably it's gravy on top of the plans already underway, right? Because the ultimate goal here is federal workforce reduction, and in turn, federal savings for the federal bottom line, right? Again, taking opinions out of the equation here, just objectively speaking, if you look at it in its simplest forms, that is the end goal, right? Make government smaller and save the government money, and in turn save the taxpayer. That's the message. And how they get there, I think, is it's fluid, right? They have many options. They also could determine that 3 months from now that this buyout isn't actually legal, or they don't actually have the funds to pay people for 6 or 9 months without actually working. There are limits on existing buyout packages within the civil service that are much lower threshold than what these would amount to, and that's the risk that some of these individuals are taking about whether this buyout will actually be honored, or whether 2 months from now they'll actually just be terminated.
Okay. So moving on from this, what else do we got going on in DC?
So we have an active Financial Services Committee and Senate Banking Committee gearing up. There was a slate of kind of, let's call them introductory hearings during the month of February, where it was really kind of an entree point into several of their key issues, right? So there was a hearing on digital assets. There was a hearing on capital formation, or there will be at the end of the month. there has been increased chatter around housing, GSE reform, and then the CFPB reform package. That one's a little more amorphous at the moment because in some respects, the executive branch is kind of handling that for now. So I could see that kind of taking a kind of a backseat to some of these other issues. And then there's the Chairman Hill's effort around a kind of a community bank centric piece of regulatory relief legislation. I think that the official term of it is make community banks great again. So naturally, it poses the question, hey, well, what about credit unions, right? I think that the name of that bill is somewhat of a misnomer in the fact that it's likely to result in a piece of legislation that probably has provisions in it that are beneficial to both credit unions and community banks. There may be some community bank specific legislation in the bill. There are opportunities for credit unions to engage as well and seek, credit union specific provisions. But the goal here is really targeting, relief for community financial institutions. But French Hill, as a former banker, naturally has naming rights on that legislation. So there's potential for that bill to be marked up sometime in March. They're still very much in the kind of the feedback stage on that, but it's something that we're keeping an eye on as an opportunity for credit unions.
Okay.
GSE, if I could just say one thing on GSE reform real quickly. So Congressman Flood, who is the chair of the housing subcommittee on the House Financial Services Committee, he was out with some comments over the last couple of days that seemed to indicate that housing issues dealing around, cost and supply, he wants to tackle in a bipartisan way, which was interesting to hear. But the point he was making is, that he knows a lot of Democrats that care about housing. He knows a lot of Republicans that care about housing. The only way to make law with respect to housing is through a bipartisan effort. And he seems, ready to jump in on that. On GSE reform, though, he commented that he thinks it's important. He thinks that the GSEs should come out of conservatorship. And then he reiterated similar sentiments of Chairman Hill that it really needs to be the administration to take the lead on that front, and that they will look to the FHFA and Treasury to initiate that process and give them, plenty of runway to, start executing on those plans before Congress, steps in and gets involved in anything.
Okay. It's one of my favorite topics. It's not going to go away. Not going to go. Maybe in 3 years. Maybe in 3 years we'll start talking about it, and then we'll talk about it again in 4 years. It's just one of those things, right? That's right. That's right. Well, just look at the time. I hate to do it because I know there's a lot going on, but we do have to wrap up. Zach, thank you very much for your time today. Truly do appreciate it.
Thanks, Peter. Always good to chat.
Of course. As always, we appreciate everything that our friends over at Brownstein do for us in our community. And to all of you, we know your time is valuable. Thank you for tuning into the latest episode of ACUMA's On Point podcast. We hope you enjoyed it. Until next time, be well, my friends.
Thanks for listening. We'll see you next time at the ACUMA On Point podcast. If not already, be sure to subscribe and give us a 5-star rating. For more great episodes and information, be sure to visit us online at acuma.org. And to get the latest updates, head over to our LinkedIn page.